Yo, what's up, guys? I'm Nathan Robert, and I just turned 20 years old today. So, yeah, today is actually my birthday. And 2 years ago today, I turned 18 and I started my investing journey, of course, in the stock market. And I'm just going to be sharing with you everything I've learned. I'm going to be showing you every stock, how much I'm up and down, and what are my goals of investing. And I also have two different portfolios here, both with different investing goals each. So, like for my moving portfolio, once I buy a stock in here, I'll never sell it no matter what. For my Robinhood portfolio, I don't really have a for sure plan yet, but right now I've carefully selected stocks that fit my criteria of stocks with low dividend yields, but also super low payout ratios. So I believe these stocks have a lot of room to appreciate in stock price and grow their dividend faster than any other stock. So these are currently the stocks on the list. Oh, yeah, except for one, TSLL. I'm going to sell this right now. So look, I bought this right before Tesla earnings. And well, of course, the Tesla exploded, so I'm up 37%. Should have bought more. It's $37, but whatever. You sell all. I don't even care. Just swipe up. But yeah, I used to own so many weird stocks here in my Robinhood portfolio. Like if we just go to my dividend history, like here are all the stocks I own now. But if we scroll back a little while, I used to own random stocks like JEPQ, NEP, American Tower, IIPR. So as you can see, I used to just own so many random different dividend stocks, but now I've carefully selected the ones in my Robinhood portfolio to have very high dividend growth rates. But yeah, I hope you guys will stick with me today. Don't forget to drop a like on the video. And I want to quickly show you who I really am. So this is actually one of my second channels, the Nathan Robert one. My main channel is actually called Shaping or Rust Moments. My peak career, I'm not saying this to brag. If anything, this is a downfall story. This needs to be studied, all right? So my peak career was about 2, 3 years ago. I used to get well over 50K views a video, making so much money. Like if I just click on a random video here, so this video got 55,000 views, and let's see if you don't know what that looks like. 5.6K watch hours, 300 subs, and $183. That's pretty cool. And but yeah, I've made every single one of these videos, every thumbnail, and I've been doing this every single week since I was, well, let's see, 3 years ago, I was 17. I've been doing it for well more than 3 years. So basically, since I was 16, I've been making these videos like crazy. So I feel like I'm made for YouTube. I just have so much fun doing it. Here's another crazy one. This one has 183,000 views. Wow. Got 22,000 watch hours, 600 subs, and $518. So yeah, this channel actually doesn't make any money anymore. So if I upload a video now on this channel, it doesn't make any money. YouTube kicked me out the YouTube Partner Program. So that's why I'm kind of moving channels now. I really like this new channel I'm making. I can't wait to see what the future is for this channel. So yeah, guys, with all that out of the way, I'm now going to reveal to you every single stock that I own and showing you how much I'm up and down on every single one of them. And the real juice of this video is going to be after this, where I'm going to show you, for especially for these four companies right here, I'm going to be showing you all the numbers that convinced me to invest in them. So all these companies right here, in my opinion, are super safe. Like this one right here, Carlisle, they actually just reported earnings yesterday. I bought it at all-time highs, and it just keeps hitting new all-time highs. That's the thing about, here's a fun fact. Whenever a stock hits an all-time high, it's statistically followed by a cluster of more all-time highs. And if you don't believe that stat, it also works the other way around, where if a stock hits a new 52-week low, it's statistically going to hit a cluster of new 52-week lows. But yeah, now I'm going to go over each stock and I guess why I bought each one of them. I'm not going to go over Powell Industries here because I own that one in the Robinhood portfolio. I might actually sell it in the Robinhood portfolio because I own it in here. But anyway, let's start at EOG Resources. We're up 15% basically, and this one is the oil and gas stock, which I own this one as a pure hedge. And if things go bad, this should do good. But check this out. You can see each stock I click, you're going to be able to see where I bought it and the cost average line. That's what the purple line is here. But this company in particular has a rule where 60% of all free cash flow they make is returned to the shareholder, either through stock buybacks or special dividends. And they have a super impressive history of doing special dividends, as I'll show you later. Now, I'm not going to go over CubeSmart because I own public storage in the other account, and we're going to go over their financials later. I love the self-storage industry, and I can't wait to show you why. But now I'll go over ticker symbol PERI. As you can see, we're down 55% on this stock, which is just crazy. I've been slowly dollar cost averaging into this stock. Like, look, it looks like every day. But then there was just this huge drop from $21 to $12, a huge revision to their earnings. It was just awful. I made a whole video about that. I won't even go into that. But we got Nike stock over here. This is one of the newer stocks I literally just bought about 2 weeks ago. And our position's doing pretty good. Like, literally, since we bought our shares, I haven't had a chance to buy them again. Like, I was like, I kind of want Nike to keep going lower because I'll buy some more shares. But no, they just kind of did a bounce off that support line. Like, they did it back here too. They bounced off this like $88 and then never went below that. And then we got DocuSign. I bought this one back in the October low, basically at the all-time low. And well, DocuSign has done very good since then. They have grown their free cash flow per share like crazy. The company is now debt free. They have so much cash that they're milking interest rates, which I'll show you later. And that's actually the case for Bill Holdings too, except Bill Holdings unfortunately has a lot of debt. DocuSign, no debt. Bill has debt. But Bill Holdings is still making $30 million in free cash flow from interest every single quarter from their cash. So even though they have a lot of debt, they're still making interest instead of paying interest because of the cash position they also have. They basically have the exact same amount of cash as debt. I'll show you that later, but yeah. So now I'm going to go into their financials and show you why I bought all of my stocks. I'm literally going to be showing you the most important financial metrics. I'll be doing this kind of quick here because I don't want to take up too much of your time, but I'm glad I'm showing you stocks that you've hopefully never heard of. Like, I'm not just showing you Apple's numbers or realty income. Like, hopefully I'm introducing you to some new stocks. But check this out. This is the free cash flow per share, my favorite metric. It includes capex, and since it's per share, it also includes stock-based compensation. So yeah, just look at the net income growth on this company. It's absolutely crazy, but that's not even why you would want to invest in them. This is the reason you want to invest in them. So first off, they have zero debt. So this company is debt-free, doesn't owe anyone any money, and they have $321 million of cash on hand right now, which is the most cash they've ever had. But look at this. This $321 million of cash on hand is making them in pure interest $4 million just in the most recent quarter. So if interest rates are higher for longer, this company is going to benefit from that. Oh yeah, here's the retained earnings. But more importantly, the dividend from this. So look, remember they just made $4 million in interest. Their dividend yield, which is just under 1%, it's not crazy, but their dividend yield, it cost them $3 million. So that's why I'm saying this company has a ton of room to raise the dividend. Even just from the interest on their cash, they could raise the dividend. You know, it's crazy. But what's the next stock we can go over? Oh yeah, I wanted to go over the self-storage REIT. So look, they basically perform the same today. That's why I'm saying no matter if I look at Public Storage or CubeSmart, it'll be the same thing. But for this case, we'll look at Public Storage because I own more of them than CubeSmart. So check this out. For REITs right here, because this is a real estate investment trust, they have to pay out 90% of their taxable income in the form of dividends. So that's why they have this super high dividend yield of 4.63% or $3 every single quarter. But I'm going to show you why they can easily afford that. So this is the number they pay out the dividend from. And as you can see, it's well above $3 every single quarter. And we can scroll back for a long time. And so this is what I'm trying to say. They have so much room to raise the dividend. And most REITs actually have to dilute you as a shareholder to acquire new assets, but not Public Storage because they keep a lot of their money. So REITs can actually choose to keep some of their money. All they do is they just now have to pay income tax on it, which is no big deal. So this company literally has not diluted you as a shareholder, which is a really great sign for a stock that has a pretty high dividend yield. And I'll quickly go over why I love the self-storage industry. You can capture inflation because it's month-to-month lease. There's so many add-ons. And self-storage is also recession resistant. Of course, it's unfortunate when people die, get divorced, dislocate, death, but all of these things actually benefit self-storage. Tenants literally have to pay because you have their stuff, and if they don't pay, you get to keep it or auction it off for more additional sources of income. Okay, so for the next stock I absolutely love, it's ticker symbol AFG or American Financial Group. And if you're a dividend investor, you're going to love this one because of their dividend history. So look at this. They have a huge history of paying out special dividends, but right now the normal dividend is 71 cents per share. And let's see, when have they not been able to afford that? Well, never. Except for this literally one quarter in 2020 caused by the pandemic, they have never not been able to afford the 71-cent dividend. And that's when we look at net income per share. And even if we go to their free cash flow per share, on a really bad quarter, it was $1.29. Of course, they can still easily afford the dividend, but look in the two most recent quarters, they basically almost had $20 of free cash flow per share. And do a multiple on that for a stock price. That means their free cash flow yield, yeah, this company has a free cash flow yield of well over 10%, which means they could pay out a 10% dividend if they wanted to. And well, if we go to their total cash paid dividend, check this out. Their normal dividend only cost $52 million. All of these other quarters are when they're paying out special dividends. So like they have a huge history of paying out these special dividends, like I said, and you have not been diluted as a shareholder. You actually now own 1.64% more of the company because they just started buying back their own stock like crazy. The company has an astounding $1.23 billion of cash even after paying out the special dividends and the stock buybacks. So $1.23 billion of cash and debt of $1.48 billion. So this company is just in such a good financial condition. And like, look, they made $756 million of free cash flow in the most recent quarter. So that right there is half of their debt instantly paid off. So look, 756 million in one quarter and the market cap of $10 billion. So like I said, the free cash flow yield is insane. Even though the stock is at all-time highs, it's still a good deal right now. Like the PE forward ratio is 11.46. I mean, that's a very fair valuation, but also this company is in the insurance sector. It's different from a lot of other things, but it's valued differently. All right, guys, now I have to go over EOG Resources because I own just over $1,000 of the stock, and it's one of my favorite dividend-paying stocks in the whole entire stock market because of the rule I mentioned at the beginning where they return 60% of all free cash flow to the shareholder. And well, let's look at their free cash flow per share. Look at this. This is crazy. I mean, remember the normal dividend. How much does a normal dividend cost? Their normal dividend costs 91 cents per share. And look at this. When have they not made 91 cents? I mean, maybe this one pandemic quarter, but look at this. Their payout ratio is like literally 10 to 20%. You know, they have a super low payout ratio, and that's why they're easily able to do these special dividends. But that's their free cash flow per share. Here's their net income per share, which is also well above 91 cents every single quarter, which is a really good sign to see. And if we double that to $1.81, this means they would almost have a 5% dividend yield that they could still easily afford. I mean, subtract $1.80 from each of these EPS. They could still easily afford it. That's a 5% dividend. And they also just started a stock buyback program. Look at this. They bought back almost like $1 billion of the stock in the past year, which is a really great sign when the company's doing that. So that's why if you go to the total common shares outstanding, you now own 1.16% more of the company. Oh yeah, so check this out. Look at their debt. $3.8 billion of debt, which is down 25% year over year. So they're paying off all this debt, right? So they only got $3.28 billion. And now, guess how much cash they have on hand? So they actually have way more cash than debt. They got $5.28 billion of cash right now. And that's this much cash after doing the special dividend and the stock buyback. So this company is just making so much money. Their retained earnings are up 22% year over year. That is nuts. All right, so now I want to show you guys DocuSign stock, and I'm going to show you why this one might actually be a pretty good deal. I mean, remember, this sucker used to be $300, and there's no splits, reverse splits, or nothing. The stock really used to be $300, and now the funny thing is, the financial condition is at its all-time high, its all-time best, but the stock is at like an all-time low. But look at the free cash flow per share growth. This is what you could do a multiple on, or you could do a multiple on their forward PE ratio, which if you look at their forward PE ratio of 17, that's pretty fair for a tech stock like this. 17 forward PE, that's pretty good in my opinion. But anyway, look at the free cash flow per share growth. It's just been insane. Or that's the EPS. But check out their balance sheet down here. Most investors are going to think this is bad, but it's actually the best thing ever. So look at the assets to liabilities ratio, which is the one in the little gold right there. It's now 61%. The quarter before that, it was 71%. So that now means you own about 10% more equity in the company. And what this really means is you're like, well, look, the assets went down. Well, so did the debt. So they actually just paid off a ton of debt, or actually they're now debt free. But whenever they use their assets to pay off debt, it just goes down, but the ratio goes up. And as we can see, their total debt, they used to have about $700 million of debt. Now they have zero debt, which is amazing. And after paying off all that debt, they still have $797 million of cash on hand. And guess what? This cash is, because of the high interest rate environment, the cash is making them $19 million of free cash flow just in the most recent quarter. Like, look at the growth on this right here. This is purely thanks to high interest rates, and companies with a bunch of cash will benefit from it. All right, guys, and the last stock we'll go over is ticker symbol NKE. Remember, thank you guys so much for being here. I mean, I wouldn't even be here if it weren't for your support. Thank you guys so much for watching. If you're still watching, don't forget to drop a like on the video. It really would help me out a lot. That's all I want for my birthday is a like on the video. And if you leave a comment, I will respond to every single comment. But check this out. This is Nike's free cash flow per share. And if you take the average of the 4 quarters of the free cash flow, it's actually higher than the 4 quarters of EPS. So the free cash flow per share, there's always that 1 quarter for Nike that's bad. Nike's dividend cost 37 cents. So look at this. It cost 37 cents. And well, they make well above 37 cents a quarter when you average it out. We can look at it from the EPS too. They make well above 37 cents of EPS as well. And they basically have the exact same amount of cash as debt. So look at this. They got $9 billion of cash and $9 billion of total debt. Basically the exact same. But yeah, seriously guys, thank you guys so much for watching. My name is Nathan Robert, and I will catch you guys in the next video.